Good morning, everybody. It's Monday, November 11th, 5:25 a.m. Central Time. Grain markets are mixed this morning. December corn futures down a quarter cent at 4.30 3/4. January soybeans up 5 3/4 at 10.36. December Chicago wheat down 11 1/2 at 5.61. December Kansas City wheat down 11 1/2 at 5.52 3/4. December spring wheat is down 9 at 5.88 3/4. In today's show, we're going to talk about Friday's USDA report, some news out of the White House regarding the trade rep's office, potentially some stuff from the California Air Resource Board, the funds and their position in the corn market, Moody's and some stuff with ADM, weekend rainfall in the southern plains, and also some flash sales. Let's start off with the USDA report.
So USDA reduced its estimate of this year's U.S. corn and soybean crops on Friday. The soybean number was the big surprise. USDA reduced its national yield estimate to 51.7 bushels per acre from 53.1 bushels per acre previously, resulting in a production cut of 121 million bushels. USDA cut soybean demand estimates via both crush and exports, which partially offset the supply cut. The U.S. national corn yield was pegged at 183.1 bushels per acre compared to 183.8 bushels per acre previously. USDA left its corn demand estimates for the current marketing year unchanged.
The soybean yield cut was the big surprise here. And interestingly, you would have thought maybe looking at the drought monitor, maybe it's going to be Indiana and Ohio. They didn't cut those numbers. Where they cut the soybean yields were in Illinois and Iowa were the two big ones. Illinois down 3 bushels from last month. That's still a record of 65 bushels per acre for Illinois. Iowa down 4.7 bushels for last month. So, it was pretty uniform except for like Ohio and Indiana and then some other places out east. The corn yield number didn't come down a whole lot, not really a material change. So the carryout estimates are reduced versus last month. The corn shift down to 1.938 is not hugely substantial. The shift in soybeans from 550 down to 470, you could argue that that's substantial. Looking at the stocks to use ratio for soybeans, these were updated following the report and premium subs. You guys have the full versions of these corn, soybeans, and wheat, U.S. and the world in the email this morning. But the stocks to use ratio, U.S. soybeans now being projected at 10.8%, which is still pretty high. It's still closer to what we saw in like 2017, 2018. It's lower than 18-19, but and a little bit lower than 19-20, but it's not bull market territory. I would make the argument that the world ending stocks to use ratio number is the more important statistic for soybeans. When it comes to corn, I think the U.S. numbers are more important. When it comes to soybeans, I think the world numbers are more important because we export such a drastically larger quantity of soybeans we grow in the U.S. We export like 40% of our beans. We only export 10 or 15% of our corn. So I think that the world ending stock situation in soybeans is a big deal. And it's hugely bearish. It's now a little bit below. The projection is a little bit below 2018, 2019, but 32.8% stocks to use is not friendly when it comes to soybeans big picture. So I still think that the big thing hanging over this is the world situation, this monster Brazilian crop that is probably on its way. That's the deal. But the market acted well. I mean, we're up this morning. We acted okay.
The former U.S. Trade Representative has yet to receive an invitation to resume his role in the new administration. Many traders had expected Robert Lighthizer return to be announced on Friday. Lighthizer served as U.S. Trade Rep during Trump's first term, overseeing the imposition of tariffs on Chinese imports. He was also involved in the renegotiation of the North American Free Trade Agreement with Mexico and Canada. There has been some talk that Lighthizer is being considered for other Trump cabinet positions, such as Treasury Secretary and Commerce Secretary. Late last week, China's top ambassador to the U.S. warned that there are no winners when it comes to tariffs.
It was initially reported at about midday on Friday that Bob Lighthizer would be back. And I don't know if it was coincidence or not, but the soybean market began to sell off following that news. So Friday's sequence of events was like, okay, friendly USDA report, beans rally. And then, oh shit, Bob Lighthizer back. Now we got to sell beans. And now it turns out to not be true. Maybe he'll have some sort of post, but this was considered to be bearish because he was the guy that was very instrumental in the trade war, back during that 18-19 time frame. So for the moment, it says he's not going to be back. I don't think that's a guarantee, though. It's just they're kind of retracting the story that was out on Friday. Interesting stuff, though.
California has updated new climate rules that could significantly impact fuel prices. Last week, the California Air Resources Board approved major changes to its low-carbon fuel standard. The plan will increase the state's emission reduction targets and provide funding for infrastructure to support charging stations for zero-emission vehicles. It will also eliminate incentives for dairy farms to capture and convert methane emissions into fuel. Environmental groups have criticized the program for promoting increased biofuel production. Additionally, there is concern that the plan could raise fuel prices by as much as 65 cents per gallon in the state.
Say what you want about the left coast, but they are the ones driving the biofuel revolution. So if they want to really reduce emissions in such a drastic fashion, which is what they ruled essentially, they have to use more biofuels. And for the moment, we've still got this deal where a lot of these, renewable diesel manufacturers, they're importing used cooking oil to make the stuff, right? But guess who's coming back to the White House in January? Trump's coming back. He's going to slap tariffs on that stuff. And I think ultimately it means we're going to have to use more domestic feedstocks for biofuels. We're already using a lot, but we're going to use more soybean oil and more things along those lines. The counter argument, as Mackenzie mentioned at the end, is that fuel in California is going to get very, very, very expensive, which could drive, and it's already super expensive, but it could drive further the push toward electric vehicles, which doesn't help out your demand situation. So there's a lot of things kind of pushing and pulling here, but I would say that this is overall a positive for biofuel usage and maybe demand for things like soybean oil as early as, first half of next year, I would say.
So if you guys have not checked out our premium content, you sure need to do so. Joe, can you tell me about some of last week's premium videos?
USDA report day is a good day to be a premium subscriber. Within usually 15 minutes of the report, I have a USDA snapshot video blasted out. These are usually 3 or 4 minutes long, and they just kind of give you the big headline items. I throw the balance sheets on the screen, and I show you exactly what USDA changed and what the implication was for ending stocks to use ratio, that sort of thing. Pete was on Thursday last week. I believe it was Thursday. Post-election thoughts. We talked about the grain markets, biofuels, a lot of the biofuel policy type stuff, and what Trump may mean or may not mean for that. Jim was on Friday. We hit the election from more of a macroeconomic standpoint. Is inflation inevitable under Trump? A lot of people think that that's the case. A lot of people think that the deportations, the tariffs, those are all inflationary in nature. But at the same time, Trump could be very positive for the economy with regard to the business environment, lower taxes, deregulation, that sort of stuff. A lot of irons in the fire here. And this was a really good video. It's a mailbag questions. If you guys want to see the premium stuff, go to standardgrain.com. You can sign up this morning. It's a $50 per month subscription. Cancel at any time, no other fee, no other obligation. Nobody will try to sell you anything else. This includes all of my cash grain marketing recommendations every single business day, broken by crop year and percentage. If you guys are busy, you can sign up on your phone. It takes like 30 seconds. Cash app, Google Pay, credit card, whatever you want to do. Super easy. Sign up this morning. I'll forward you a copy of this morning's email.
The funds shifted to a net long position in the corn market last week. As of Tuesday, November 5th, large money managers were net buyers of 39,000 corn contracts. The net long of 3,000 contracts comes only 4 months after the fund set a record net short of 356,000 contracts. This is the first time the funds have held a net long position in the corn market since August 2023. Funds were also net buyers of 5,000 contracts of soybeans and 2,000 contracts of SRW wheat on the week.
Pete Meyer bet me $10,000 that the funds would not go long the corn market this year, and I said that they would. So Pete owes me some money, and the interest on his outstanding debt begins to accumulate today. Interestingly enough, so the funds, as you mentioned, they were net short 356,000 contracts in mid-July, and now they're net long 3,000. During that time frame, that massive short covering event, corn market rallied less than 20 cents. Pretty unimpressive. I guess what this would imply is that there was a lot of farmer selling of both old crop bushels, new crop bushels. The question now moving forward is, do they want to take an aggressive net long position? Keep in mind that the funds it's not one trader. It's a whole group of traders, and this is their net position. There are some funds who are short. There are some funds who are long. This is a net position. The basis of my bet with Pete, I said the funds would go long corn, is that they go long corn every year. And just about every year, they find a reason to go long 100,000, 150,000 contracts. I don't know what the reason is. Is it because export demand is good? Is it because ethanol production is good? Maybe you run into some sort of South American production issue, but here they are net long. On soybeans, still net short SRW wheat. When you combine these three contracts, they're still short 88,000 contracts in net. But I know a lot of people were interested in the corn, and short covering event has come and gone.
Moody's has lowered its outlook for ADM's credit score. The reduction was due to continued errors in ADM's methods of reporting transactions. The decision was made after ADM discovered more accounting issues last week. The company's initial accounting errors were found back in January. ADM has lost billions of dollars in market value this year as a result of the continuous discovery of these errors. Moody's held the company's rating at unchanged. Moody's held the company's rating unchanged at A2, which is 5 notches above junk.
So Moody's is thinking about lowering their credit score, but they haven't done it yet. As we mentioned last week, I think ADM's in some trouble here. The stock has acted horrible. So ADM's down 28% year to date, while the S&P's up almost 26%. So big divergence between ADM and the broader stock market. I feel like there's maybe something we still haven't heard about with the accounting stuff. I don't know. We'll see what happens, but it doesn't look good.
Weekend precipitation was substantial across U.S. hard red winter wheat country. Areas of western Kansas, eastern Colorado, western Oklahoma, and the Texas Panhandle saw 1 to 3 inches of rain over the weekend, with greater totals reported locally. The system was a mix of snow and rain as it crossed the Colorado-Kansas border. U.S. winter wheat ratings have been poor, partially as a result of dryness in these areas. HRW wheat futures traded below technical support overnight.
Yeah, this was very welcome rainfall in terms of the wheat crop. Ratings were not good. Largely, there was dryness in the Midwest too, with the SRW crop, but HRW wheat country had been incredibly dry. Some of this was snow, some of it was rain, but the totals look pretty darn good. I think this is why wheat's down this morning. And I don't know if you'll see the ratings improvement tomorrow. All the reports are delayed a day this week because of Veterans Day, but I don't know if you'll see it reflected in the ratings tomorrow, but you may see it in the following week.
USDA reported multiple flash sales on Friday. U.S. exporters sold 4 million bushels of soybeans to China for delivery during the current marketing year. U.S. exporters also sold 5 million bushels of soybeans and 8 million bushels of corn to unknown destinations for delivery during the current marketing year.
Flurry of smaller sales, but we'll absolutely take it. What did cattle do on Friday?
Cattle futures closed sharply lower. Live cattle were 80 cents to 212 lower. Feeders were 167 to 290 lower. Cash cattle prices slipped last week. In the Southern Plains, cattle traded at 187. That was $3 lower compared to the previous week. Up here in Nebraska, cattle were $2 to $4 lower at 186 to 188. Box beef was lower on Friday. Choice ended the day at 307.93. That was down $1.53, and Select ended the day at 279.19. That was down 53 cents.
We do have some movement in the outside markets here on Monday morning. U.S. dollar is higher. The stock market is higher and posted fresh all-time highs on Friday. The S&P traded 6,000 for the first time. Bonds are off a little bit. Gold's getting smacked down $22. Crude oil is down $1.32 at 69.06. Bitcoin's trading above 82,000 this morning. Huge run up over the weekend when most financial markets were closed. Happy Veterans Day, and thank you to all those who served. Have a great day, guys. We'll be back on Tuesday.